Welcome to our deep dive on the backdoor Roth strategy for high earners. If your income blocks you from contributing to a Roth IRA directly, this video will show you a legal path to tax-free growth anyway. We'll walk through how the maneuver works, the crucial tax insights, common pitfalls like the Pro-Rata Rule, and a step-by-step plan to execute with confidence. To keep things flowing, we'll transition smoothly from concepts to diagrams, examples, and quizzes. Let's begin. Here's our roadmap. First, we define the backdoor Roth. Next, we cover the must-know tax rules. Then, we move into a step-by-step guide and the Pro-Rata Rule pitfalls with solutions. After that, we walk through a real number example and highlight Form 8606 requirements. Finally, we'll test your understanding with short quizzes before summarizing action steps. At a high level, the backdoor Roth involves making a non-deductible contribution to a traditional IRA and then converting that amount to a Roth IRA. This sidesteps the income limits that normally prevent high earners from contributing directly to a Roth IRA. While the concept is straightforward, the tax details matter. So next, we'll unpack those tax rules to avoid costly mistakes. Here's the quick mechanism. First, put non-deductible money into a traditional IRA. Because you don't take a deduction, that creates after-tax basis. Next, convert that traditional IRA balance to a Roth IRA as soon as practical, ideally minimizing any interim earnings. Finally, file IRS Form 8606 to document your non-deductible contributions and the conversion. Once in the Roth, your future qualified withdrawals are tax-free, which is the entire point of this strategy. Now, let's transition into the tax insights that determine what is and isn't taxed during conversion. This flowchart illustrates the money flow. You start with after-tax cash and contribute it to a traditional IRA as a non-deductible contribution, which creates basis. Next, you convert that traditional IRA to a Roth IRA. The basis portion converts tax-free, but any earnings are taxable at ordinary income rates. There's also a checkpoint for existing pre-tax IRA balances, traditional, SEP, and simple IRAs, which trigger the Pro-Rata Rule if they exist at year-end. Finally, filing Form 8606 is essential to document both the non-deductible basis and the conversion. With the process mapped, let's cover the critical tax insights in more detail. These are the rules that matter. First, your non-deductible basis is tax-free when you convert. You already paid tax on those dollars. Second, any earnings that occur in the traditional IRA before conversion are taxed as ordinary income upon conversion, not as capital gains. Third, the Pro-Rata Rule aggregates all your traditional, SEP, and simple IRAs as of December 31st of the tax year. If you have pre-tax balances in any of them, a portion of your conversion becomes taxable according to a ratio. Fourth, to limit taxable earnings, reduce the time between contribution and conversion. Finally, you can estimate the tax by multiplying earnings by your marginal ordinary income tax rate. Let's quantify this. Suppose you have $14,000 of properly documented non-deductible basis and $5,000 of earnings in the traditional IRA. If you convert the full $19,000, only the $5,000 of earnings is taxable. At a 35% marginal rate, that tax is $1,750. The non-deductible basis converts tax-free, assuming perfect basis tracking. The key is accurate records and timely filing of Form 8606. This pie chart visually separates the conversion into two parts. Roughly 74% represents the non-taxable basis, while about 26% represents taxable earnings. Your actual percentages will vary, but the principle is the same. The basis is tax-free, and earnings are taxed as ordinary income during the conversion. Follow these steps in order. First, list all of your traditional, SEP, and simple IRAs. Second, if you have pre-tax balances, consider rolling them into an active employer plan, like a 401k if the plan accepts roll-ins. This can remove them from the pro-rata calculation. Third, set up both a traditional IRA and a Roth IRA. Fourth, contribute to the traditional IRA on a non-deductible basis and record the amount and date. Fifth, to reduce taxable earnings, keep the funds in a low volatility option briefly before conversion. Sixth, convert to the Roth IRA promptly and set tax withholding to zero so you don't shrink the converted amount. Seventh, once in the Roth, invest according to your asset allocation. Eighth, File Form 8606 to document the non-deductible contribution and conversion. Verify that your traditional, SEP, and simple IRA balances are zero by December 31st to avoid pro-rata complications for that year's conversion. Finally, repeat each year you're eligible, and it makes sense. Let's compare two paths. With a direct Roth contribution, eligibility is restricted by income, but the process is simple with no pro-rata complications and typically no basis tracking on Form 8606. In contrast, the Backdoor Roth is designed for high earners who exceed income limits. It requires a non-deductible contribution to a traditional IRA, followed by a conversion to a Roth IRA. However, it introduces pro-rata risk if you have existing pre-tax IRA balances and requires precise Form 8606 documentation. Quiz time. During a backdoor Roth conversion, which part is taxed? Option A, the non-deductible basis. Option B, the earnings in the traditional IRA. Option C, both basis and earnings. Option D, neither basis nor earnings. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is B. Earnings inside the traditional IRA are taxed as ordinary income upon conversion. Properly documented non-deductible basis is not taxed when converted. Second quiz. Which accounts are aggregated by the Pro-Rata Rule at year-end? Option A, traditional, SEP, and simple IRAs. Option B, 401k and 403b plans. Option C, HSAs and FSAs. Option D, Roth IRAs. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is A. The Pro-Rata Rule aggregates traditional, SEP, and simple IRAs as of December 31st. Employer plans such as 401ks are not aggregated, which is why rolling pre-tax IRA funds into a 401k, if allowed, can help avoid pro-rata complications. Form 8606 is mandatory to document non-deductible IRA contributions and Roth conversions. Accurately reporting your basis and conversions protects your tax-free treatment on the basis portion. Keep copies every year so your running basis is clear. Refer to the current year's IRS instructions for exact line references and requirements, or consult a qualified tax professional. To mitigate the pro-rata rule, strive to have zero balances in traditional, SEP, and simple IRAs on December 31st of the conversion year. If you hold pre-tax IRA assets, consider rolling them into an employer 401k that accepts roll-ins. Minimize the gap between contribution and conversion to reduce taxable earnings. Set withholding to zero on the conversion so the full amount moves into the Roth. Maintain thorough records, including all Form 8606 filings. Finally, coordinate with a tax professional regarding timing, state taxes, and your broader situation. Best practice is to convert the entire non-Roth IRA balance when executing the strategy. This cleanly relocates all future growth into the Roth, where qualified withdrawals are tax-free. While you may incur a one-time tax on accumulated earnings, the long-term benefit of decades of tax-free compounding often justifies the cost, particularly for younger investors. Our earlier example showed that converting $19,000 with $5,000 of earnings results in tax only on the earnings portion, assuming accurate basis documentation. This video is for educational purposes only and does not constitute tax, legal, or investment advice. Tax laws change and individual circumstances vary. Before implementing any strategy, consult a qualified tax professional or financial advisor who can evaluate your specific situation, including state taxes, plan rules, and timing considerations. These are the core points. The Backdoor Roth allows high earners to bypass income limits. Non-deductible basis converts tax-free, while earnings are taxed as ordinary income. The Pro-Rata Rule aggregates your traditional, SEP, and simple IRAs at year-end, so plan to avoid pre-tax balances. Form 8606 is mandatory for documenting basis and conversions. Finally, converting everything helps move all future growth into the Roth's tax-free environment. As we wrap up, identify your existing IRA accounts and whether your employer plan accepts roll-ins. Map out the sequence. Contribute non-deductible dollars, convert promptly, and file Form 8606 accurately. Time your actions to avoid the Pro-Rata Rule and to minimize interim earnings. Revisit the process annually and coordinate with your tax professional to align with your broader financial plan. And now, one final request. Thank you for watching. If you found this helpful, please like the video, share it with someone who could benefit, and subscribe for more. Tell us in the comments how you're approaching the backdoor Roth, what obstacles you've encountered, and what topics you'd like covered next.